All right, welcome back, everyone. Today we're talking about health savings accounts. Danny, you excited?
I am. I definitely want to talk through this. I myself have not had a chance to use one of these yet, due to having a low deductible, as we'll get into later in the episode. But it's an account that is very attractive to me.
I'm in the same boat as you. I have always been really, really intrigued by health savings accounts. I've just never had the opportunity where I take that back. There was one time when I could have used one, but our situation at that time did not make sense
Absolutely.
to use one. So, but we can go into that later. But to our listeners, health savings accounts, for the rest of this episode, we're just going to refer to that as an HSA. That's what a health savings account is. That's the acronym for it. So I figured we'll dive right in. Danny, number one, what is a health savings account? An HSA, right? So this is basically a special account that you can save money in for future qualified health expenses. You get a tax deduction on the contribution. It grows tax deferred, and it's tax-free when you take it out, so long as they're used for qualified medical expenses. That's in a nutshell. Now, there are some nuances we need to unpack with all of that, and we'll jump into that in a little bit.
Okay.
The important thing, though, is to know whether you have an HSA eligible account. So
what do I need to do in order to be HSA eligible?
yeah, I think the most surefire way, rather than playing the guessing game and trying to figure it out for yourself, is contact your maybe HR, whoever your employer, whoever's in charge of your benefits at work, and just look at your health insurance options. Usually, not always, but usually it will say if it's HSA eligible, that type of thing. But some of the technical requirements, if you will, now this is for the year 2024, this changes as limits and whatnot update each year. Basically, in order for a plan to be HSA eligible, you have to have a minimum deductible for in-network coverage of either $1,600 for a single plan or $3,200 for a family plan. You also have to have a minimum out-of-pocket maximum for in-network coverage of $8,050 for a single plan or $16,100 for a family plan.
Yeah. You will sometimes hear that minimum out of pocket called the MOOP.
Sounds like a moot point to me. I don't know.
Yeah.
I love that. The MOOP.
So
yes,
with the HSA account, correct me if I'm wrong, but I believe that employers can offer these through whoever manages their retirement accounts, or you can also open them through an individual brokerage as long as you qualify.
yes, that's
Okay.
correct. That's correct. Yes. So if your employer has an HSA eligible health insurance plan, they may have an HSA account directly through their own portal or through their own benefits package that you can contribute to, and sometimes directly from your paycheck, right? It could just be deducted from your paycheck. Other times, they may not have that. And so even if your plan is HSA eligible, you may, like you said, Danny, have to go to an actual custodian and open an account.
Yeah, and that custodian will just confirm your eligibility with your employer.
I believe so. I don't know for sure.
Okay.
That is because I've never been through it myself. I think that's true, but if they don't, it may just be that you have to be an honest person and open it up, because
Okay.
if you are ever audited by the IRS and you open an HSA, you start contributing to it when you're not actually eligible to do so, that would obviously turn into some trouble down the road. So
there may be some penalties in your future if
Yeah.
you do that.
that's not a good idea. So yeah. So number two, what is a qualified medical expense, right? So I mentioned earlier, Danny, just a minute ago, that it grows tax-free, tax-deferred really, and it comes out tax-free if used for a qualified medical expense. That's an important thing to know, because if you withdraw money from a health savings account and it is not for a qualified medical expense, it is subject to not only tax, but also a 20% early withdrawal penalty.
That's a pretty heavy penalty.
Yeah, not early withdrawal penalty, just non-qualified withdrawal penalty, basically. So we'll get into something later on about when you turn age 65 and how that penalty goes away, but that's important to know. So with a qualified medical expense, it's a pretty broad definition. To our listeners, definitely invite you to look up and verify online before you treat something as an expense if you're not sure if it's a qualified medical expense, look it up first. But in general, anything that's used to treat or prevent, illness, whether physical or mental, typically counts. Doctor visits, your deductible on your health insurance, right? If you're paying your deductible, that counts. co-pays or co-insurance, things that you're responsible for that your insurance doesn't kick in to cover, prescription drugs, if you go to the dentist, go to the eye doctor, things like that. Danny, I've even seen certain things on Amazon, as you know, and to our listeners, if you haven't heard, I had my first child recently, my son, and I was on Amazon looking for a breast pump for my wife to be able to pump breast milk. And I'm pretty sure
What a good
it
husband,
said
doing breast pump research.
well,
for your
I shouldn't take all the credit. She definitely did 90% of that.
Okay.
But I do recall seeing, I'm pretty sure it was with the breast pump. I don't know for sure, but I think it was, that it said HSA eligible.
Nice,
Meaning
very nice.
you could potentially use your HSA to cover that. So you have to double check that. A couple little caveats that are important to mention. If you are paying for long-term care insurance, those premiums can also be paid for from your HSA, but you are subject to certain limits based on your age.
Okay.
So there's only so much you can use from it for the long-term care premium based on your age. I generally only see this kind of with individuals more in their upper 50s, younger to mid 60s
Definitely.
who are in the market for that. But there are some people who purchase a long-term care insurance policy at a young age. I actually personally know somebody who's in our age group in the 30s.
Interesting.
Who's getting, I've never seen that.
I don't want to go too far down that trail. But there's definitely a pivot point where if you purchase that too young, you will lose out overall.
Opportunity cost.
Yes.
Yeah, for sure. Another caveat, you generally cannot use an HSA to pay your health insurance premium itself, right?
Okay.
Unless you're age 65 or older. Generally if you're age 65 or older, you can, so long as it's not going towards something that's a Medicare supplement policy.
Sure.
It can't be one of those. It has to be just a regular. Anything other than that. The only exception is COBRA or health insurance premiums if you are receiving unemployment compensation. So if you lose a job, you're on unemployment compensation, you obviously still need health insurance, or maybe you're on COBRA. Those are times when you may be able to access the HSA to pay for those premiums. But unless you satisfy one of those very unique criteria, they're very situational. In general, you should just assume you can't use your HSA to pay health insurance premiums. I think that's important to mention. Another thing is, generally, the qualified medical expense should be incurred after you've already had the HSA open. I know that seems like common sense, but you'd be surprised how many people, they might get a plan open in the middle of the year, but they had an expense at the beginning of the year and they think, oh, I'll just go reimburse myself for that qualified medical expense that I had. But if your HSA was not open at the time, or you didn't have one open, it's important to know that you can't just go back and reimburse any expenses you want that happened in the past way before you ever had an HSA to begin with. So be mindful of that. Danny, we're going to get into this when we talk about some of the tax savings, but there's not really any time limit to when you can take an HSA distribution, right? You can incur a qualified medical expense. You could pay for it out of pocket. You could hold on to that receipt for years even if you wanted. And then at some point in the future, so long as you still have that proof that you paid for it and it's a qualified medical expense, you can reimburse yourself for that expense. There's no time limit to do that.
So
and
we're going to dive into the specifics of this in a later section. However, basically, as long as your HSA account was already open prior to that medical expense, you can then hold on to the proof of that medical expense for decades potentially, and then reimburse yourself on that expense using future growth. That's the concept.
Correct.
Okay.
Yeah. And it's not just your own expense. You can also reimburse for your spouse's expenses or your children's, your dependent, basically, expenses. So it's important to remember that too. But moving on, number 3, Danny, let's talk about contribution limits. This is an area that some people actually get confused about. There are a couple things that a lot of people don't realize are at play here. So in general, if you are on a single plan for the year 2024, the HSA contribution limit is $4,150.
In 2024.
In 2024,
okay.
Yeah. And if it's a family plan, it's $8,300. If you are age 55 or older, or you will be by the end of the year, the calendar year, you can do a catch-up contribution of an additional $1,000.
Okay.
So there's that. But then there's this important thing that you have to be aware of called the pro rata contribution rules. So unlike an IRA where you can just make the lump sum contribution to the account, doesn't matter how long you've had the account open or how long during the year you were eligible to make an IRA contribution. With an HSA, yes, those are the contribution limits I just mentioned, but you can only contribute insofar as the number of months you were eligible for that HSA.
Interesting. So the total contribution limit, let's say 4,150 for a single person, is split into 12 like equal increments.
Yes.
Okay.
Yes. So if you only have an HSA open for 11 months out of the year or 7 months out of the year, then you have to do that pro rata calculation where it's 4,150 divided by 12 to get what it is in 12 increments, and then multiply that by the number of months you had an eligible plan open for. So even though that's the max, you may not be able to contribute that full amount if your HSA was not open for the entire year. That's something to be mindful of. Now, there are, as everything in financial planning and taxes, there are always exceptions to rules, right? And that's what makes this so complicated sometimes. So some of the exceptions, right?
Just before we dive into the exceptions, just want to confirm or call out that equals $345.83 for repeating each month of the year.
Yeah. Now you can make contributions above that, right? Now, and this is where one of the exceptions is, right? So let's say this is called the last month rule. Let's say you are going to be covered by December 1st of this year, and you are also going to be eligible for the entire following calendar year, but you open your account later in the year, right? You didn't have it open the whole year. Well, so long as you satisfy those two things, you're going to be covered by the HSA eligible plan by December 1st this year, and you'll be eligible the whole following calendar year, then you can be treated as if you were covered for the entire year. You could just max out the whole contribution.
Interesting.
It's called the last month rule. I won't get into all of the details on it, but I want our listeners to be aware of that. The last month rule with HSAs, you can look that up if you think you need to cross that path. Just be mindful that if you mess up that last month rule, like you think you're going to be eligible the following calendar year for the whole year, but then something happens and you ended up not being, you might actually be subject to a 10% penalty on the overfunding of it, if you will.
Plus tax, right?
Yes.
Okay.
Yeah, because you got the tax deduction,
Yep.
but then you find out that you're not eligible for that tax deduction. Yeah, good call out. But yeah, the pro rata rules, basically they come into play like if you started coverage this year and you didn't have eligible coverage for the whole 12 months, that it comes into play. Or if you're changing health care coverage, or maybe you're older and you're applying for Medicare, or maybe you're losing HSA eligibility in the middle of the year. Those are all situations. Basically, anything that would cause you to lose eligibility during that 12-month period, you have to be mindful of the pro rata rules. I think that's important.
That's good to know. So number 4 is triple tax savings. Say that 5 times fast. Can you explain what that means?
Yes. So this is what is so intriguing to a lot of people. The HSA is, I think, the only account that I know of that has a true triple tax savings, meaning you get a deduction on the contribution, it's tax deferred growth, and it comes out tax-free on the back end when you take withdrawals for qualified medical expenses. A Roth doesn't do that, right? Because you don't get a deduction up front.
Correct.
You do get tax deferred growth, and they can be tax-free withdrawals. A traditional IRA doesn't have that either. You do get a deduction on the front, and it grows tax deferred, but you don't get tax-free withdrawals. This is just one of those unique accounts where you have tax benefits on all three. Let's talk about the deduction part first, Danny. So you make a contribution to your HSA. It's going to come from one of two places. One, it's either just going to be immediately deducted from your payroll, right? It's just going to show up as an adjustment on your pay stub. And in that sense, it's effectively the same as a deduction, but you don't see it show up as a deduction on your tax return. It's just income you earned is just simply removed from your pay
not
stub.
Counted in that total, correct?
Correct.
All right.
But the unique thing about having it deducted from your payroll is that you are also not subject to FICA taxes, payroll taxes like Social Security and Medicare, right?
Yeah, additional 7.65% on top of your nominal tax rates.
Yes, okay. And so I don't know if this term has been coined, but maybe we say if you have an HSA and you're having it just completely, automatically deducted from your payroll, maybe it's not triple tax savings, but quadruple tax savings, right?
Quadruple tax savings. All right.
Yeah, we can coin that term. So, but if you decide to make a contribution yourself outside of your payroll, like when would that happen? That would happen when you have an HSA eligible plan, but perhaps your employer doesn't host an HSA itself where it could just be deducted from your payroll, and you have to go out and do it yourself and make your own contribution. In that scenario, you do not avoid the FICA taxes. Your paycheck is still subject to
Okay.
the payroll taxes.
So you get the triple
And
tax savings instead of the quadruple tax savings.
yes. So if you go that route though, when you make a contribution to your HSA, you will need to track that using IRS form 8889, or in other words, 8889. And then you have to attach that to your Schedule 1, Part 2, line 13. And that is where it shows up as a deduction on your tax return.
Okay.
So just keep that in mind. IRS form 8889, and that shows up. It attaches to Schedule 1, Part 2, line 13, at least on the current tax form. If they change the tax forms in the future, then who knows what line that will be. The second part of the triple tax savings, Danny, tax deferred growth. This one's pretty self-explanatory. It's just like any other tax deferred account. You take those funds, you put it in the HSA. Some HSAs have investment options you can utilize, like index funds or whatnot. They usually have like a money market fund of some sort.
And that's one of the very unique things about HSAs, right? It may be called a health savings account, but it is very different than an FSA or a flexible spending account, in that the flexible spending account is literally just a savings account. The HSA, even though it says savings, can be used as an investment account and take advantage of compound growth over time.
Yeah. I mean, I don't know why they don't change it to HIA, health investment account, right? I mean, could be one way to look at it. But yes, it's totally true. And that's one of the unique things about it, given the ability to reimburse yourself in the future, taking advantage of that tax deferred vehicle that you may be able to invest in the market for long-term performance. It could be a really unique planning strategy to leverage if it works for you. Now, it's worth mentioning, not all HSAs are the same. Depends on the custodian. You may or may not have a lot of investment options available to you. You just have to, see what they offer. But that is essentially what you need to be looking out for. That's that tax deferred vehicle that you may be able to invest the underlying funds. We'll get into some of that in a little bit too. Applying some wisdom to that, whether you should invest all of it, whether some of it should be in cash. We can cross that bridge in a few minutes.
Okay.
So,
and my guess will be that your distribution and your allocation within the account will really depend on what your intentions and planning for that account in the future are.
definitely.
Okay.
And I think you said the right word, intention. I think if you are going this route to use an HSA, I think there needs to be some intention behind it, like some deliberate planning, just because it does require a little bit of management. I think, to be mindful about how you plan to use it. I think that's something we'll get into that in a minute. So the third part, Danny, tax-free withdrawals. So we've already gone through this. They have to be for qualified medical expenses. We've already mentioned you can reimburse them in perpetuity. The idea here is that you make a contribution to an HSA, you invest it in some type of fund, you let it grow for years and years and years. Now you have this growing pool of assets. As we all know, medical expenses tend to accelerate dramatically as we get older.
Absolutely.
Right? And so that is one of the biggest things that comes to haunt retirees that they often underestimate, is just the rate of inflation on medical expenses, which usually outpaces regular inflation. And you never know what's going to hit you, right? You talk to anybody, maybe some elders in your family, you'll find stories all over the place. Things seem to be fine, and then all of a sudden a health scare happens and your quality of life changes, and you have these expenses you have to be mindful of that you were never anticipating. Getting things in an HSA, getting money in an HSA early so that it can take advantage of compound growth over years, perhaps decades, and then be available in the future to reimburse qualified medical expenses. Talk about a return on investment, right? Like, that is a unique way to leverage a triple tax savings feature to offset these future medical expenses that we can pretty much say with certainty are going to happen, right? Like, it's going to happen.
Absolutely. I have a personal example. Had a moderate level surgery within the family recently, and the amount billed by the hospital to the insurance company was $185,000. So those bills can come very unexpectedly, and having a ideally quadruple tax advantage account that has been compound growing over time can definitely help to alleviate that pressure.
Yeah. I mean, obviously, medical insurance usually kicks in to cover some of that shock, but even after that, people are often surprised by how quickly how expensive medical scares can add up. And so I think that's the biggest thing to paint here, to really set the stage for somebody who's thinking about this. It's important to really envision this far into the future. Like, take a step back and just imagine multiple decades playing out in front of you. And if you understand that the triple tax savings feature, and you understand the concept that as we age, medical expenses are very likely going to increase at an exponential rate,
Yep.
you can start to see how this plan materializes to your benefit. It's pretty powerful.
Just to kind of piggyback off of that, the current estimation is that every person in the U.S. In their later years is expected to spend somewhere between $250,000 and $300,000 on medical expenses in the latter third of their life.
Wow, that's really interesting. Maybe something we'll have to revisit, Danny, because we don't have the numbers prepared today. But I wonder if we wanted to prepare for a future value of, say, $300,000 by a certain age, and we know you can only contribute so much to an HSA every year. How many years do we have to contribute, assuming a certain growth rate, to be able to hit that, $300,000 mark in the future? I don't know. Maybe we'll revisit that at some point. That'd be cool. So, but if you're one of the lucky who is pretty darn healthy, especially as you get older, the nice thing about the HSA, and I hinted at this earlier in the episode, Danny, when you hit age 65, you can then use your HSA for anything you want without fear of the 20% penalty, right? That 20% penalty is for anything that's not a qualified medical expense, but that does drop off after the age of 65. At that point, you can just use it for anything. But if it is not a qualified medical expense, you are still going to owe tax on that withdrawal. You're just not going to be hit with the 20% penalty.
So after age 65, so that cutoff is 5.5 years later than access to a 401k or an IRA, right?
Yeah.
But after age 60 or at age 65 and later, it can be used in the same regard where you can withdraw and you pay ordinary income tax on those withdrawals.
Correct.
Okay.
Yeah. And so, yes, there are some restrictions to this type of account, but if you really think about the triple tax savings feature and the broad definition of a qualified medical expense and that age 65 cutoff where the 20% penalty drops off, I think people don't give the HSA enough credit for how flexible it is.
Absolutely.
There are some flexible features built into it. Yes, there are restrictions. You have to be aware of them, but don't sell it short. There is some flexibility to be leveraged. This is the fun part, Danny. Number 5, cool planning strategies to use with your HSA. We've already touched on portions of these, but obviously invest in it for the long term. Save all of your receipts, right? Have a big old file of all qualified medical expenses you've had over the years. Now you just have a tax-free pool that you can reimburse those expenses strategically as you see fit. Maybe you're in an odd tax year where there's something tax sensitive happening and you need to withdraw money. You're like, darn it, I don't want to withdraw from this account because it's going to cause additional tax liability. It's going to affect my adjusted gross income. It might affect my modified adjusted gross income. It might affect certain tax deductions or credits or thresholds I need to be mindful of. Well, here I am sitting on this big old pool of qualified medical expense receipts, and I'm just going to strategically pick some and reimburse myself for them, pull from this account that's been growing, and I can use that money. Remember, you've already paid for those expenses, right? Now you're using the money for anything you need, but you're just reimbursing yourself in the future for these qualified medical expenses that may have happened even years ago.
Because for qualified expenses, they are withdrawn completely tax-free. You are not adjusting your total income above those thresholds you're trying to avoid exceeding.
Right. Some of the same logic with like using a Roth account, right? Like you may be in a strategic year where it's a very tax-sensitive year, and rather than pulling from a taxable account or an IRA that is or taxes ordinary income, you might use a Roth. The same logic applies to an HSA in this case. Another thing too, we mentioned it, obviously, if you are able to contribute to an HSA via payroll deductions and also avoid FICA tax, that could be an interesting way to save on additional taxes in any given year if that's available. One thing I will mention though, your FICA taxes, especially the Social Security part, goes towards increasing your future Social Security benefit.
Correct.
And I forget what the limit is for 2024. I'm forgetting what there's a certain income limit where you're taxed on Social Security. And then when you're above that income limit, you're no longer taxed on Social Security. You're just taxed on the Medicare portion. Might be a moot point, but If you're under that threshold and you're doing HSA contributions via payroll deductions, thus avoiding paying more Social Security tax, in theory, you may be decreasing your future Social Security benefit by a tiny portion. Now, whether that's going to have a meaningful impact on your finances, maybe decades in the future, because who knows what Social Security will look like at that point. I don't know, but I do think it's worth at least mentioning that. If you're earning way above the limit, the income limit, then it's also, I guess it doesn't really matter at that point. The FICA tax savings doesn't matter in that case. So not that it doesn't matter, it still benefits you, but you're not worried at that point if it's going to be reducing your Social Security benefit, is what I mean to say.
I'm going to jump in, and I think for 2024 it is 168,600. But again,
it's jumped up a lot.
We will confirm and correct that within the notes.
Yeah, I just looked it up, Danny. I'm getting $168,600. So the next fun planning strategy is coordinating your HSA as part of your emergency fund. So let me explain what I mean by that. To our listeners, if you haven't done so, the episode we did, the emergency fund conundrum, that's a good episode to go check out. Danny and I did a huge deep dive into the emergency fund. And one of the things we talked about was, how do you determine what your emergency fund should cover, right? A lot of people say 3 to 6 months of expenses. And we go into, well, what does that mean, expenses? Is that, required living expenses, that also discretionary? If it is discretionary, what percentage, blah, 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 blah.
Absolutely.
We go down that deep hole.
That discussion caused me personally to adjust my emergency fund and how I viewed it and the kind of things that I was bucketing for.
Yeah. And so part of that conversation, we talked about how you might actually also add your health insurance deductible amount as an additional layer to your emergency fund. You might have settled at a certain number of expenses and whatnot, but then you might also say, in addition to that number of months I want to cover in my emergency fund, I also want to be able to cover my health insurance deductible, which is not a monthly expense. That's like totally unexpected. If you have a health issue, you weren't accounting for that in your monthly budget. It's just, here you go. Here's a big medical expense, and you might have to pay your whole deductible. If you like that strategy, one thing I like is the idea of using your HSA and saying, you know what, I'm going to contribute to this HSA and I will invest it, in an index fund if it's available in the account, but I'm always going to at least keep the portion of my deductible in a safe liquid cash account. Maybe it's like a money market account in the HSA. That way, if something does happen, I can access that and use it because a deductible is an eligible expense. And I can use that if there's an emergency. Now, you may disagree with that. If you have a high risk tolerance and you're okay with your funds being invested in the market subject to sequence of returns risk, that's fine. Just be aware that if you have a health issue and you need to pay your deductible and it just so happens that the market has dropped, then you might be looking at a situation where you're trying to access funds in your HSA, but you're going to sell something at a loss to then cover that expense. So just keep that in mind. It's going to come down to your personal risk tolerance, I think.
Yeah, talking about these planning strategies, I believe that a lot of people, when they can afford it and they can manage that cash flow, if they're going to be investing the HSA capital, then they are maintaining or attempting to maintain that those cash or cash equivalents outside of the HSA in order to front load those payments or make those payments out of their cash flow in order to preserve the tax deferred growth of the HSA.
I totally agree.
Okay.
If your strategy is to really focus on that long-term plan we were just talking about, then yeah, you may be better off just having the cash outside available and just leaving that alone so it can grow with the market over, decades. So last planning strategy, Danny, this one is not really well known and it's pretty unique and it's situationally dependent, but here's how it goes. If you are over the age of 18, but you are under the age of 26, and you are on your family's HSA eligible health insurance plan, but they are not counting you as their dependent for tax purposes, right? Like maybe you're in college, right? You're an adult, you're moved out, but you're under 26 years old, but you're on because you're allowed to stay on your parents' health insurance plan up until that age, but they may not be claiming you as a dependent on their tax return for tax purposes. In that scenario, you can individually contribute to an HSA up to the family max limit, which in 2024 is $8,300.
Wow.
Even though you're a single, you can contribute up to the family max, and it doesn't affect your family's ability to contribute up to their max as well.
That's incredible. That is a very interesting planning strategy. So if you're fortunate enough to have that income coming through at that age, and it's, free cash flow after contributing, you've got your emergency fund squared away, your debts are under control, contributing to your retirement accounts, etc. That is a huge boon if you can contribute to that and have it set up that early in life so that it has a long time to grow.
Yeah, it allows you to super fund it
Absolutely.
much quicker than the average single person would be able to, right? Danny, I mean, talking about what we just discussed with the long-term plan of like having that compound at your advantage, if you're in that age group and you're able to effectively double the amount you can contribute than an otherwise single person could, talk about supercharging your contributions early on to really get that compounding going. That's a unique opportunity to consider if you do meet those specific requirements.
Very true. All right.
Yeah.
So the last one, number 6, is who might an HSA be good for?
Yeah, exactly. And Dan, I think this will also cover some of the cons, right? Because as we discuss who an HSA might be good for, I think the first one I want to highlight is somebody who's young and healthy and doesn't have some obvious upcoming medical expenses, right? If you are young and healthy and you typically don't see yourself going to the doctor very often, you don't have a lot of medical expenses or issues, this might be a really good strategy for you. I think the important thing to do is be honest with yourself about how often you are actually going. Because one thing is for certain, when you do the HSA eligible plan, yes, the premiums are generally quite a bit lower than the more, Cadillac plans with all the bells and whistles. Quite a bit. So you see your cash flow from your paycheck increase because you're lowering that medical insurance expense, the premium expense. But when you do go to the doctor, a lot of people experience what is known as sticker shock, right? Like
100%.
they're so used to their regular doctor visit just being covered by the insurance. Maybe you have like a $10 copay or a $20 copay, whatever it is, right? And that's it. You walk away and you saw the doctor, whatever. On these HSA type of plans, it's not uncommon for someone to go to a regular checkup or a doctor visit for something. And next thing you know, you have a bill in the mail for $200, $300, whatever it is. Like, you're like, what the heck? I had hardly did anything. Like, I just went to the doctor
Absolutely.
there's sticker shock. And it just takes one time to experience that where people start to go into a panic and think they made a big mistake. But if you actually take a step back and you look at the amount that is deducted from your paycheck, let's say you have a Cadillac plan, like all the bells and whistles, gold plan, whatever they call it. If you add up all of the paychecks you receive throughout the year, and you add up all of the deductions they take for that plan, especially if you're paying up for the plan, you start to realize, wow, I actually paid a lot of money for my health insurance, but it just didn't feel like a lot because it's just coming out of my paycheck and I never even saw it.
Yep, out of sight, out of mind.
Exactly. But with an HSA eligible plan, it is very much in sight and on mind, right? Not out of sight and out of mind.
You have to have managed the spending and cash flow in order to absorb that sticker shock.
100%. In this case, I think if you're doing the HSA plan, calculate the difference between what you would otherwise pay for the gold plan or the bells and whistles and save that difference. Save it.
Yep.
Like, get in the habit of saving it. I think that will help with some of the sticker shock. So,
and I'm just going to call out, we are not trying to downplay how expensive healthcare is. As I mentioned earlier in the episode, we know exactly how expensive health bills can be, and they come at unexpected and inopportune times.
Absolutely. So, Danny, with my recent child back in, last year, so it's 2024, so this would have been around August 2023, my wife was coming up for her benefits renewal, right? And so she had to sit down with HR person and go through and elect her benefits and see if she wanted to make changes. We made a couple changes. We added short-term disability so she can make that claim for pregnancy, and they did change the health insurance. I do believe there was an option that was technically HSA eligible, but we decided not to go for it because we had all of these expenses coming out. We knew that our child was going to be born sometime in late January, early February. And so we thought to ourselves, HSA sounds really cool, but these are predictable expenses we are absolutely going to be hit with in the very near future. And so we took a step back and we said, we're not going to do it. We're going to stick with the gold plan. And I'm personally very glad we did, because I think, talk about sticker shock and talk about actual cost savings, I think we would have been financially worse off if we went with the HSA plan.
Sure.
Almost certainly,
Yep.
right? And so I'm young, I'm healthy. My wife is young and she's very healthy. By all measurements, we are perfect candidates for an HSA. But because we had these upcoming expenses, we were able to tactically decide, you know what, for this year, we're not going to go that route because it's probably not going to be to our benefit.
I'm going to clarify that. I would say by those measurements, you are perfect candidates to utilize the HSA as a vehicle for future growth and capital appreciation.
So that's why we ended up going that route. But it's going to really come down to a person's situation, right? That's the thing to be mindful of. The other thing too is who might it be good for? On the topic of sticker shock, I think it is important for somebody to have a proper emergency fund. Perhaps it is saving that difference between the bells and whistles plan versus the HSA eligible plan and putting that in your emergency fund. It makes it much easier to handle those sticker shocks when they come about if you do have a proper emergency fund established.
Absolutely. Last thing you want to do is put those medical bills onto, say, a high interest credit card or something.
Oh, gosh, I know. And then you're just compounding these expenses that you're unable to handle in the moment when they happen, right? And on the same topic, a stable job, right? If you are worried about losing your job or you think you're going to, hit a point where you might be laid off or, the writing's on the wall, you're not so sure, you don't feel safe and secure in your job. I don't know. Maybe think twice about the HSA eligible plan. Yeah, you could probably keep it on Cobra, but like if you're going to potentially be at risk of losing your job, well, then you're probably not going to be contributing to an HSA anyway because you're out of income, right? And so that's something to be mindful of as well. And then, Danny, I think the last one is just from a behavioral standpoint. If you are somebody who has very good self-control and is very disciplined and organized, and you can meticulously track, log your expenses, and save your receipts, then this strategy could play out very well for you, right? But if you're somebody who lacks that discipline and is generally not very organized, I just don't think it's worth the risk putting yourself in a situation where you've contributed to an HSA, you've lost all your receipts, you're 10 years in the future, and you have this money in there. You would have liked to reimburse some of those old expenses, but you don't really have a way to substantiate them with evidence.
Sure.
Where did they come from? Where's your receipt, right?
That's something we do have to admit. If you are holding on to these receipts or these proof of medical expenses, you have to be able to organize that, maintain them, and keep them safe over decades, potentially.
Yeah.
Receipts fade to the point that you can't read them. You will need electronic records that you can keep safe, or printed not receipts, printed statements showing what you paid, that you are able to keep in a safe place and organized that you can reference and pull from in the future. So that is something to be aware of, right? If you realize you're going to have trouble substantiating these in the future, you may need to think about how you use the account.
Right. And kind of on the self-control side of things too, Danny, if you're somebody who has a spending problem and you're going with the HSA eligible plan, which does increase your paycheck, right? Because they're generally cheaper for the insurance premiums. If you're the kind of person that sees that extra cash flow come in and you're tempted to just spend it, you might be negating a lot of the benefits that you hoped to achieve with the HSA strategy. Because if you're not building up reserves to handle those sticker shocks when they come, it could put you in a pinch, and then you may regret having gone that route. So that's something to be mindful of too.
That makes sense. Well, I think that's everything we kind of wanted to talk to in terms of closing thoughts. I don't currently have an HSA, but it is certainly something I would consider and will continue to evaluate, as our financial situation changes in the future. What about you?
Yeah, likewise. I'm very intrigued by the account. I think there's a lot of power in that triple tax savings, and for the right individual,
Quadruple tax savings, sometimes.
We got to coin that. For the right person who can manage that and is healthy and doesn't mind that sticker shock aspect and understands conceptually that, hey, even though it's sticker shock, it doesn't necessarily mean you're paying more because the more expensive version is just being deducted systematically from your paycheck. If you understand all that, it might be a good fit for you. And yeah, Danny, I'm keeping this in my back pocket as something to be open to should my wife and I, perhaps through a future job change of hers, if we get access to one of these, I'm going to be strongly considering it, given our situation. But in the meantime, I'm just kind of waiting to see what happens. But if you're somebody who has access to one of these and you think you might be a good candidate, do your due diligence, look into it, take a lot of the things we said to heart and be aware of the pros and cons. But if you're a good candidate for it, it's good to start early in looking into these things before making a decision.
100%. And to anyone listening, if you currently utilize an HSA, let us know in the comments how it's worked out for you and how you're managing and working it into your finances and retirement plan.
Seriously, yeah, I would absolutely love if anybody has comments on this, because I have yet to personally use one myself, and I always love to hear firsthand personal experience of people who have used them. How has it worked out for you? What roadblocks have you run into that have actually negatively affected you? And what are some of the positives you've seen? But anyway, this has been awesome, Danny. Thank you so much. And thanks to all of our listeners for joining us again. Hope you got something out of this, and we'll see you next week.